When we produce a rating on a company, these are the areas of analysis that we pay attention to. Industry and economic risk, which sets the operating environment that the entity is working within. The competitive position, what is its revenue generating capacity? Does it control that competitive position? Management and corporate strategy, where does the management team want the company to go? Enterprise risk management sits sort of in the middle. It's the control framework that ensures the company will reach those objectives. Operating performance, does it make money? Investments, what's the quality of that investment profile? Does it have sufficient liquidity to meet unexpected claims events? What is the quality of the liquidity of the company? How strong is the capital? And at the bottom, financial flexibility. Where does the money come from if it wants to expand, if it needs to correct a failing position? So, practicing them into the way that we present this information in our final ratings profile, the top three we put under what we call business profile. It's not entirely qualitative, but it's a very heavily qualitatively driven interpretation of the information we receive. Financial profile is operating performance, investments, liquidity, capitalization, financial flexibility, numbers driven. Do they have a profitable underwriting earning? Do they have attractive capital adequacy for what they're doing? Somewhere in the middle, always rather awkwardly, I think, in some of the presentations we give, is this often nebulous concept of enterprise risk management. But I would emphasize that what we're doing is asking the company how they set the controls that they're working to ensure that if they're looking for a 10% return on the capital, ultimately they can get there. Or if they have a risk tolerance framework that says we don't want to lose more than a percentage point of our capital base, how do they control that across the spectrum of risks? This is when I borrowed this slide earlier this week, it had a rather clumsy title that I didn't borrow in this presentation. I've called it a flowchart of how the component parts of the rating process link together. And in versions I have used of this at an earlier stage, the box at the bottom, just above the bottom, enterprise risk management, actually sits outside this arrow chart. It sits above the whole lot and covers the spectrum of risks and assessment categories. And I still prefer that aspect because enterprise risk management is there to control what the company is doing. I don't think that economic and industry risk feeds directly into how enterprise risk management is working, and then it feeds into capital adequacy. That is a misstatement in my opinion. But this is the slide that I've been asked to use. But we'll elaborate upon this. So, we look at enterprise risk management. The ratings process is, in a nutshell, we sit down with the company's management team, we set them an agenda of items that we want to talk to them about, covering those areas that we've just looked at. One of them is enterprise risk management, another one is management and strategy. They're clearly linked. But in our mindset, management and strategy focuses on the success of the business planning process, its implementation, the development of strategy. Are they looking to do something that the management team doesn't have the skill set to deliver? Or that the economic risks surrounding that particular development plan appear irrational? If a company comes to us and says, we want to set up a new operation in the United Arab Emirates, we want it to grow by 20% per annum and achieve $1 billion dirhams worth of income by 2015, we would say, well, what are the management skills you have to develop that franchise? And we would then look at the tools the management is using under risk management to make sure that it fits those sorts of loose parameters. So enterprise risk management is the operational control framework developed and implemented to deliver strategy successfully and consistently. Successfully and consistently. We want to see it in action. We can't deliver an opinion on enterprise risk management if we don't know that it actually works and you can't demonstrate it to us. So, when we look at ERM, we look at the following component parts. Some of you may have seen this slide in a more traditional Gothic or Greek portal concept with risk management at the bottom, three pillars of risk control processes, emerging risks management, risk and economic capital models sticking up, and a big triangle of strategic risk management sitting over the top of them. I've never been particularly happy on that, so I took the graphic aspects out. But what we're looking at is how does the management of an organization set the risk culture? If the management is looking for aggressive targets, business growth, profitability, expense control, claims management, well, that's what they set. We would then look at the control processes that they have in place to monitor the delivery of those aspects. We also want to see how the company manages unexpected risks, emerging risks as we call them here. Natural catastrophe risks are a typical emerging risk or unexpected risk, but we know that they're going to happen. We know that there will be an earthquake at some point in the west coast of America. We know that there will be an earthquake in Turkey. There will be an earthquake in Italy. We don't know when they will be, but we expect the management of the company to have a plan in place to reduce the exposures that they have as a result of those events. That moves us on to the next item, risk and economic capital models. We'll come and develop these thoughts later on, but if a company is identifying all the areas of risk that it needs to control, and it is setting parameters around the impacts of those risks, then they can develop economic models, capital models, risk models to feed in data to drive out probability scenarios for what will happen to a company in a set of circumstances. The last item here, strategic risk management, focuses on the optimization of capital. Now, optimization of capital is dependent upon what management wants to do with it, shareholders as well, of course. But the point is, I think it's a reference to that insurance companies typically manage capital to a relatively constrained level. Capital is not readily accessible. I'll draw a contrast with the GCC area later on. But if you're working in the United States as an insurance company, if you're working across Europe as an insurance company, then the regulatory environment that is in place in those countries tends to focus mindsets on minimum capital levels. The reason is that investors want to maximize their returns. The regulators want to have sufficient capital in place and the assets that go with that to manage the loss exposures to ensure policyholder security. We don't quite have that mindset here in the Gulf, I would suggest. So, how does Standard & Poor's assess enterprise risk management? We have these four areas: excellent, clearly the best; strong, adequate, and weak. The majority of companies that we look at currently fall into the adequate bracket. And within that, we then have three sub-levels: adequate, which is just good enough; adequate with strong risk controls; and adequate with positive trend. Companies which we assign adequate with positive trend are moving into the strong category, assuming they maintain that level of delivery. A fundamental difference between adequate and strong: companies that don't have strategic risk modeling will not get a strong assessment of enterprise risk management. We expect companies with strong enterprise risk management to have the ability to model their risk framework to a variety of stress levels and demonstrate that it works. And if we put a company into the strong level of enterprise risk management, we will then set that company an additional agenda as part of our analytical process, and our enterprise risk management specialist team will go in and monitor that level of enterprise risk management in greater level of detail to make sure that it supports the analyst's assessment that it is strong. And you will see in our publications for the company, we assess enterprise risk management as strong because of the following factors. So that is the analytical approach to risk management. What do we look at? Well, we've spoken about defining the risk management culture. We then have these areas of risk. I'll go through them item by item. Underwriting risk. Are you setting the prices properly? Do you have a sufficient track record of correct pricing with regard to the loss incidents that you are experiencing as an insurance company? If you're writing new lines of business, do you have access to the correct level of data to set the tolerances for the pricing that you're setting? Catastrophe risk speaks for itself. Reinsurance risk. How do you choose the reinsurers that you're using? How do you make sure that the risks you're accepting are properly covered by the reinsurance profile that you have agreed to? Reserving risk. How accurately do you as an organization set your loss reserves and, of course, your premium reserves for the mix of business that you're exposing the company to? Are you simply following the regulatory requirement, or are you using more sophisticated tools? This is changing here in the United Arab Emirates. Having set particular premium levels for the lines of business, companies are now moving to the more actuarially sophisticated processes. What difference does that make? Life insurance risk. Classically, we're looking at long-term life expectations. How are you coping with changes in aging rates for the company? New products. How are you designing new products? What are the risk tolerances you're setting for a new line of business being introduced in 2012? Will you run with it for 6 months, 12 months, 2 years? At what point will you decide enough is enough and we need to abandon it? Operational risk. More of a catch-all for everything that's left over on the business side. But the examples have been mentioned today. Key man risk. Who are the key men in your organization that drive it forwards, that generate the profitability, that control the overhead to deliver the profits and the expectations you're making? Let's give you some examples. We're all familiar with the events of the Arab Spring of 2011. Standard & Poor's responds to that by looking at the quality of the sovereign ratings in the marketplaces. On the insurance side, a more direct threat to the companies that we're looking at and ones that we're not looking at is, can they actually undertake their operations in those marketplaces? Be it Cairo, be it Manama in Bahrain, be it Muscat in Oman or Tunis. The discussions we have with companies indicated that they had put in place some years ago business continuity processes to make sure that in the event of any event taking place, be it a political event, be it a social event, be it a catastrophe of some sort, that they can actually continue to service their clients' needs. That is part of the operational risk. Key man risk. What happens if your chief executive, your general manager disappears? How would that affect the business? Well, let's put that into context. My wife and I